Excellence in our industry comes from quality teams creating quality products. In an industry that's constantly evolving, it's your unwavering grit, determination, and passion that drives innovation and elevates standards to new heights. As brewers ourselves, we know what that passion looks like. It's the drive to create something exceptional, fueled by dedication and love for the craft. As a stainless steel equipment manufacturer for over 10 years, ABS Commercial provides a full consultative approach to our customers, from consultation and design to installation and ongoing care and maintenance. Whether you're in planning, just getting started, or looking to expand, we're here to support your growth and your success. Thank you for choosing ABS Commercial as your trusted partner.
Hey everybody, my name is Maria Pearman, and I'm so happy to be with you today. I am a CPA and specialize in beverage alcohol. I've been specializing in beverage alcohol for about 15 years and work really deeply in the beer and spirits space. I'm so happy to be joining you here at Craft Beer Professionals. I love this organization because it really does a fantastic job of fostering community and capturing the spirit of the industry, the collegial nature that makes it so special, and to be able to participate in that and I hope give something of value means a lot to me. So thank you for having me. I'm headquartered in Los Angeles, and I lead the food and beverage practice for my accounting firm. We have a nationwide food and beverage practice, and although we're headquartered in LA, our clients stretch all over the country. I wanted to talk today about the power of projections, and it's my mission to expose you to projections and help you see that they are, I believe, the superior decision-making tool for business questions that come your way. I like to think that projections are the next best thing to a crystal ball. Projections put into dollars and cents the expected outcome of any situation. And in business, you have 100 decisions that come your way every day, and oftentimes the choice or making the right choice can feel really nebulous. You're not sure where you're going to end up if you go down various paths. But I believe that if you just start to ask why and peel back the onion and continue to ask why, that eventually you get down to a level where there's not a whole lot that is not known about a situation. So projections are one technique to start to peel the onion and pare it back to something where you can make sense around different decisions that you need to make it could be on a day-to-day basis or things that are more broad in nature. So the main focus of my time with you is to look at some common decision-making tools, talk about the 3-in-1 advantage of a projection, and then just to walk through some examples. So common decision-making tools, I mean, it's things as basic as your pros and cons list. It could be non-quantitative in nature, so like a board of directors conversation, or even conversation with your key employees or other colleagues that you have in the industry. You may get a little more specific and put together a SWOT analysis. SWOT analysis is making a list of the strengths, weaknesses, opportunities, and threats of a given scenario. And then financial projections is another common decision-making tool. The reason why I think financial projections are the best and why one might want to make it its friend is because it allows management to examine the expected result of various actions. And strong forecasting practices have shown better financial outcomes, more stable cash flow, better access to the credit and investment that can help your business grow. In short, it's just a really good practice to get into. Financial projections also can serve as an important barometer for the health of your business. And while it may seem impossible to look into the future, really, when you start to work with financial projections, that is a way for you to turn the page, turn the corner, and see what lies ahead if you follow a certain line of decision making. So, the 3-in-1 advantage is the fact that in a financial projection, it gives you a 360 financial view. And what I mean by that is that you can build a projection that shows you a snapshot of your income statement, your balance sheet, and your cash flow statement. So there are 3 basic financial reports, those that I just mentioned. And by the way, when I say income statement, that term is synonymous to profit and loss statement. So throughout this presentation, I'll be talking about an income statement. That means the same thing as a profit and loss. So within the world of financial reports, there are 3 basic reports, and a robust projection will include all 3 of those in one place. And it shows you different aspects of your business. The balance sheet is the health of your business. It's the temperature of your business. I like to think of the balance sheet as if you were to stick a thermometer in your business. That balance sheet will tell you the health of it. It'll tell you if you have enough liquidity, if you're over leveraged, many aspects of health at a moment in time. The income statement is different. It shows you the performance of your business over a period of time. So balance sheet is a moment in time, income statement is a period of time. The income statement is, I think, the one that most people have the easiest time understanding and gravitating towards because it's pretty intuitive. You've got your income, so how much you're making, your cost of goods, how much it costs to sell the things that you sell, what's left over, your gross margin, operating expenses, net income, and it's showing you the bottom line, what's left at the end of the day. It's telling you if your business model works. So income statement, period of time, balance sheet, a point in time, and then the statement of cash flows, I like to think of that as measuring gas in the tank. While it doesn't show you anything about the health of the business, it is critical because, as we know, cash is the lifeblood, and the statement of cash flows is going to help you keep your finger on the pulse of that. I've worked with hundreds of breweries through the years, and when I have experienced those who have gotten into dire straits financially, a lot of it has to do with cash flow and the fact that their cash runway gets really, really short when they weren't anticipating it. In other words, they hadn't planned for it. And, you wake up one day and you've only got 3 weeks of cash runway left, and that leaves you very little chance to do anything that might rectify the situation. So in my experience, I've seen so many situations of tough times that could have, if not been avoided, better planned for through the use of financial projections, because financial projections gives you a tool to look forward into the future. The snapshot that you're looking at on the screen is taken from a pretty robust financial projection. I will, when we get into some examples, I'll walk through things that are simple in nature and how to build them versus things that are more robust in nature. And the intent is to give you some idea of the landscape with projections. I think a lot of people get turned off by projections because it feels daunting. It feels like you're going to have to foresee every little detail. And so that can be intimidating, and some people put off doing it because of that. It does not have to be that way. There are ways to do a financial projection that are simple in nature, but still can put you light years ahead of where you are today without any visibility. But in this particular projection, you see that we've built out a 3-year quarterly financial projection. In this, I'm only showing a little snippet, so you only see a couple columns here, but the full thing would be in Excel, and I'll come back. I want to put a pin in that comment about being in Excel. I'll come back to that in just a second. But you would see columns that go out by the quarter for 3 years. Then you can also see at the top there's an option for scenario with a drop-down menu. In this particular scenario, we have options for best case, base case, and worst case. And in this format, you can toggle between each one so that within one model, you're getting a sense of different scenarios within that one model, and you can kind of toggle which direction you think the company might be moving, which is quite helpful. I've also done a lot here. I mean, this is a very short snippet of all the data that's in the model, but you can see that we've got a forecasted income statement. Again, revenue, cost of goods, gross profit, operating expenses, EBITDA. EBITDA stands for earnings before interest, taxes, depreciation, and amortization. And that's a very helpful measure of business performance, and it helps. It's a measurement that lots of businesses use. So when you're trying to compare yourself to others, it is quite helpful to know what that number is, because other businesses also use EBITDA as a measurement. It's also a good proxy for cash flow. So EBITDA doesn't always equal cash flow, of course, but it is much closer to cash flow when you get things, operating cash flow, that is, when you get some of these other elements like depreciation and amortization in your income statement. Those are non-cash expenses, and so if you've got $200 of depreciation every month, that's dragging down your income, but it actually has no cash effect because it's just a financial theory, a financial construct, as opposed to a cash impact. Interest and taxes are also commonly pulled out of expenses because they are things that depend on how the company was set up. Let me give you an example. Let's say that there's a brewery that starts operations. Brewery needs $1 million to get set up and running. They take $500,000 of that from the owners, and then they finance the other $500,000 from a bank. So that company is leveraged by $500,000, which is the borrowed money, and they'll pay that back with interest. So imagine that as scenario A. Scenario B is another brewery, same exact setup, needs $1 million to get going. The owner happens to be quite wealthy and is able to fund all of that out of his or her pocket. So in that situation, there's zero interest that needs to be repaid. So when you look at two companies that are exactly the same, the one that has the interest expense appears like it is struggling compared to the one that does not have interest expense, but in reality, that's just a function of how the company was financed. So for that reason, interest is sometimes pulled out to kind of equal the level or make a level playing field for companies that have differences in how they were established. Taxes is sort of similar. Taxes depends on your corporate structure. If you are a C corporation, the business itself will pay tax. If you are a partnership or an S corporation, the business does not pay tax. That all flows through to the individual owner. So again, a situation where companies that are operating exactly the same would appear to have different bottom lines because of the tax situation. So that is another reason why it's pulled out, and EBITDA becomes a common denominator for measuring performance. In this model, you can see that we've got a bottom line of net income, and I want to advance, so skip over balance sheet just for a second and then go down to the cash flow statement section. You can see that the Q1 net income of negative $44,744 feeds right into the top line of cash from operating. Same thing, 44,744. So a model is built in such a way that the inputs rely on one another, and the aspect of one income statement will flow right into the next financial statement. And it makes it a seamless integration. Another thing to note here is with your balance sheet, your liabilities and equity, that section is going to change quarter over quarter based on the income or loss of the previous quarter. So you can see here, Q1 shareholders' equity is 149,968. That same number in the next quarter is 104,297. If you were to take the difference in that, the difference is the net income for the quarter of negative 44,744. So it is a way of tying all of those three basic statements together in one place, and it can be very helpful. Now, a second ago, I said that I wanted to come back to the concept of Excel. Most of us are using some type of accounting system, QuickBooks, NetSuite, Orchestrated Beer, anything like that. With those systems, it can be very difficult to build your cash flow projection in the system itself. And let's think about this, for example. Let's say that you wanted to do a cash flow projection that goes out 1 year. Well, if you were going to do it in QuickBooks, for example, you would need to put in like dummy AR invoices and AP invoices to populate the system with data about what you expect to happen far into the future. And you have to create these dummy invoices because you haven't actually received the real invoices in real life. So you have to make this, false scenario. And then that becomes very convoluted and confusing because then you have to remember to go back and delete the fake stuff once you get the real invoices in. So for a number of reasons, it's fraught with lots of opportunity for error, and I highly recommend building your forward-looking projections in Excel. Most of the time, it will be harmonizing between the historical data and the projected data. So you may take your historical income statement, dump it into Excel, and let that be the starting point for the new projection in a new workbook. And then all the future looking periods, those are calculations that you're building right in that model as opposed to extracting it from your accounting software. So I just wanted to make that point that it's always best to try to build this in Excel or Google Sheets if that's your method. But don't do it within the software that you use for your day-to-day accounting. Okay, so I want to talk about some use cases and examples. The first thing is going through scenarios that might prompt you to use a projection. So this is a very short, brainstorming list of situations where it might be helpful. But we'll talk about, like equipment purchase. Maybe there's some sort of big purchase and you want to see what that's going to look like financially, not only in the near term, but in the long term as well. So it helps you see the financial impact of new equipment, and it'll also help you foresee when your company will outgrow its current structure. When I say a projection and helping you foresee your current situation and when that will become a pain point, that's very helpful because, as we all know, it takes several months, if not a year, of lead time to start to figure out how to expand. That could be because you have to, vet your vendors. It could be because of the wait time for equipment. It could be, if you're buying anything overseas, the shipping and the tariffs associated with that. It could be just running the numbers on different ways to expand. Some companies may choose to turn to a co-packer, co-manufacturer for expanding as opposed to building a new facility. So for that reason, just having a projection at all times that goes out into the future, at least a year, is very helpful to help you see around the corner and understand when things are becoming not sustainable. The other thing with forecasts, with projections, is that it helps you really think through all the cascading aspects of a big purchase. So let's say that you've got, a can line that you want to buy and it's $300,000, and off the cuff that seems like a reasonable purchase, but then it gives you an opportunity to walk through all the steps involved. You're going to have to think about the time the timing of that. How soon can you get it? How long is it going to take? What are the installation costs? What are the terms of this? When you have to put down a down payment, when will the final payment be due? How does this impact your labor force? Maybe you get to cut some positions, but the equipment is complex enough that it requires a new hire of someone who has different skills and is already on the team. Then you're thinking through things like, what does this mean for my employment benefits, my employer taxes, that type of thing, my insurance. So it just a whole cascading series of questions starts to percolate when you put this down on paper and putting it into a financial model. Another situation where projections can be really helpful is in hiring a key position. Let's say that you are a brewery that's in growth mode and you think that you want to hire a sales manager. And that person would not be responsible for necessarily selling per se, but they are really architecting the entire sales plan. Perhaps they are doing distributor management. They're definitely organizing the sales team. All of this, you see it as an opportunity to take the sales to the next level, to help your brewery get to where you know it can get to in terms of sales. And this position is quite the linchpin there. So although it might be expensive, you have a hunch that it will unlock a lot more gross margin because this position will be able to drive sales. And then that gross margin falls to the bottom line. So that's another situation where you want to think through hiring this key position, plug it into your model, see what the numbers tell you, and in that process, it's also going to unlock a lot of subsequent questions. Things like, okay, I know that if I can hire this key person, I think that we can 2x our sales. Well, what does that mean in terms of the infrastructure behind it? Do you have the right brew house size, the right number of fermenters? Do you have the right access to capital to hire more salespeople to support new markets that this key position might help open? It is, a cascading effect. And although you might look at somebody and say, oh, I can afford to pay you 150 grand a year, I think that's no problem. When you start to work with a projection, it's going to force you to think through all the downstream effects of that and what this means for other aspects of the business. You may get to a point where you say, man, if we 2x our business, not only are we going to need to hire all of these other sales positions, but also if I think about our back office, we don't have the personnel to support the additional paperwork that would entail. So I think I need to budget as well for another staff accountant. So things like that. Expanding territory with a distributor, same situation. With an expanding territory, this is an interesting question because it's kind of like, dangling a piece of candy in front of brewery owners because it's like, oh, expand territory and we're going to go increase our sales and grow. But it can be a really slippery slope because every time you expand territory, it's like, adding a child to the family. You got to make sure that you've got the proper distributor management, the proper sales feet on the street. And there's, again, this whole cascading effect. There's also the issue of forecasting in what the initial load in of that territory is going to be, and then really thinking through what the recurring sales you expect are. What can often happen with new territories if you're not prepared with the right support on the ground is that you'll have a big load in and you might bump up sales by $50,000, but then you're sitting on that territory and it's not cycling again for another 6 months or something like that. So by putting this down in a model, it helps you see realistically what, off the cuff might seem like a really good idea. How does this actually play out in dollars and cents? What kind of additional capital do we think we're going to need to turn this into reality? Opening an additional tap room is another really great exercise for a projection. What you can normally find with tap rooms is a nice business model. If you happen to be a brewery that has, let's say, 3 or more tap rooms, you're going to start to understand what the business model for one footprint, what that looks like. And so you'll start to have a sense of, okay, it's going to take us $1 million to do a build out. We're going to not be able to be profitable in this particular sector for 4 months. But after we turn that corner, we will basically break even on this segment of the business within 14 months. I'm making up these numbers, but you can start to see what the pattern is. And usually with opening tap rooms, if the markets are, relatively similar, you can replicate and feel pretty confident about what the result will be. When you layer this into a projection, it's nice because you're going to be forced to consider what's the amount of the build out, how am I going to pay for it, what is the difference between the cash that I outlay today and when do I start to see cash return from this? What type of positions do I need to hire and when? All of this stuff will come to light using a projection. Estimizing enterprise value. So enterprise value is shorthand for saying, what's my company worth? If you're interested in selling your company or buying another company, you're going to get very familiar with the term enterprise value. And in a transaction, most value is attributed to how much future cash flow a company is expected to generate. Projections can really help substantiate the value that you desire. It's one thing to go to the market and say, we're for sale for $10 million. It's a second thing to make that statement and then back it up with forward-looking projections that go out about 3 years and substantiate those numbers. So if you're thinking about entering the world of mergers and acquisitions, projections are a must-have. And I wanted to walk through before we get to examples, I want to talk about how complex it should be. So it depends on the situation. If you are thinking about going through a sales process, for example, I recommend having a robust and professional financial forecast. And that is important because not only will it substantiate value, it also signals to the market that you're a sophisticated seller, and it's going to get you a lot of points in terms of speaking not only to your business acumen, but also it is a nod to how the historical financials, how solid they are, they can be relied upon. Now, this isn't to say that it shortcuts the due diligence process. You'll still have to go through quite a bit of due diligence, but having a professional and sophisticated, robust financial projection will send the right signals to the buyer that you are a quality asset. On the other hand, if you're a small enterprise and you perhaps are the owner-operator and you're just using this for your own purposes, a financial projection can be much more simple, and it can still be of great value to show you how different scenarios will play out in real life. For my recommended minimum, I think you should have an income statement and a statement of cash flows. Projected balance sheet is a nice to have, but not necessarily a have to have. I think at a minimum, you would want a quarterly cadence for 18 months. You can ramp this up. Obviously we were looking earlier at a forecast that was 3 years long by quarter. You can also make it more frequent. You can do, a monthly or even a weekly cadence. The weekly cadence, I typically reserve that just for cash flow forecasting when times are tight with cash. On the whole, I think that a weekly projection is too granular. And I do think that quarterly is going to help you see at a high level. But sometimes you want to really get into the nitty-gritty. In those situations when cash is tight, you're trying to thread the needle, monthly and weekly work great. A working capital calculation is a nice add-on. It basically is telling you how much cash you want to have available in the balance of your cash accounts. Inflation adjustment, if you're working on a multi-year projection, it's nice to have an ability to add in inflation adjustment. So like, let's say that for your cost of goods sold, direct materials, for example, let's assume that you think that's all going to stay the same year over year, with exception to an adjustment for inflation. So you can add that into your projection. Various scenarios in one workbook. This is what we saw earlier with, looking at a best case, base case, worst case scenario. It can be nice to just simply toggle between those three. Otherwise, you're creating three separate workbooks, and it can be difficult to see, to compare and contrast between them. And then sales forecast elements. I love really getting very detail oriented with Salesforce or sales forecast projections. I like to have in there different assumptions for rate of sale, points of distribution, and unit price increases. It is one thing to say sales are going to go up 10%, and it's another one to dig in and exactly identify where that change is coming from. Because all of these three, rate of sale is velocity, that's how many units you're pulling through on the shelf on average. Points of distribution, how many different places can someone go buy your product? And then third, the unit price increase. Each of those elements plays into increased sales. But if you can say, think about this, sales are going to increase 10%, okay, versus saying rate of sales increasing by 3%, PODs increasing by 3%, and unit price increasing by 4%. That's a lot more helpful information, and the more detailed that you get, the more actionable you can get. So we're going to look at kind of a gamut of simple and then taking it up to something that's a little more detailed and robust. So I'm going to get out of here and get into Excel, and that's my contact information if you need to contact me. So let me change real quick what I'm sharing. Okay, so let's start over here, and I'm going to make this a little bit bigger. And I just want to help you see the lay of the land. So you can tell that I'm working in Excel and that I have a multi-tabbed workbook down here. What we're looking at is a historical income statement. And let me preface this by saying that in this sheet, I've hidden a lot of rows. So, if some stuff seems abnormally abbreviated, it's just for the sake of not overwhelming the data. But basically what I did is it took 2023 income statement, dumped it into Excel. So we've got our income, we've got a section for wholesale sales, packaged and kegged. We've got a section for taproom sales, draft, beer to go, merch, etc., private events, blah, blah, blah. Then we have the corresponding COGS as well. So in our COGS section, we've got labor, we've got our direct materials wholesale COGS, our direct materials taproom COGS, and then we get into OPEX. So just quickly going through that, some highlights. We've got our taproom payroll, insurance, taproom supplies, sales expense, blah, blah, blah. Come down, and we've got net income at the bottom. So this is our historical, and it's what we're going to use to start our forecast. So I want you to notice here that when we're looking at, let's see, total income is this line. So total income last year was 6.4 million, and our net income was just under $500,000 loss. So keep that in your back pocket. Now, let's go over to our budgeted income statement. This budgeted income statement, just for the sake of illustration, I'm assuming that in 2024, we are estimating that wholesale sales increases by 10%, packaged beer wholesale increases by 10%. That is, our assumption for the baseline budget. So, I'm sorry, not 10%, 5%. So basically, our budget contemplates that, and our baseline budget gives us total revenue of 6.46 and a loss of 420. So our loss our budgeted loss for 24 is better than what we actually did in 23, but we're still budgeted at 420 as a loss. And then we've also got our budgeted cash flow forecast. So this is the budgeted cash flow forecast based off of our budget that we just looked at. If you were to compare, you would see that the net income here agrees with what is on the other sheet. So for example, January, we've got a loss of 119. Our budgeted income statement for January is a loss of 119. So those two numbers tie together. Then we have some elements of operations that we would add back or subtract to get to our net cash flow from operations. This is basically how much cash is generated from the operations of the business. We've got a section for investing, and investing typically means, in the world of breweries at least, typically means equipment. So if you're going to add equipment, this is where you show that. Or if you were going to sell something, you would show it here. And then cash flow from financing, typically this is going to be payment of debt. And so payment of debt service, that includes the principal and the interest, and then any equity contributions or distributions to owners. And then we take the total change in cash, which is cash from operations, from investing, and financing. And that's what we expect to get for the month for total change in cash. We've got a beginning cash balance and then an ending cash balance where we just subtract the change in cash for that period. So we've got this as a baseline forecast. But then the company is thinking, okay, I think we need to buy a can line. So they wanted to model out what buying a can line looks like. We've got an assumptions tab over here. When you're building a model, I recommend just writing out your assumptions because it can be very helpful just to make sure that you've got your thinking written down in one place and can always refer back to it. So in this, we assume that the equipment will cost $300,000. There's going to be an additional $25,000 for installation. We'll need to pay 50% down, 50% upon delivery, and it's going to take 4 months to get it. We think that the new can line will increase our canning output by 40% more packaged goods. Okay, that's great. However, we also are considering the other equipment that surrounds that can line, and we've got some output restrictions from our existing fermenters. So our existing fermenters, we can only push 15% more beer with existing fermenters. So that means now, like, we could increase with the can line, but now we've got a different linchpin in the production process, which is the fermenters. And we've run the numbers, and we think that with our existing tank farm, we can get 15% more. So important to remember. With the canning line, we could cut one person from the canning line and save $30,000 a year. However, the can line is a little more complex, and so we think that we would add an additional $60,000 position for the person who is we would need to put in as a supervisor there. So net, we actually have $30,000 of additional personnel. Okay, then I've got some numbers in here of our FOB. I'm putting in an average high and low FOB per case, average high and low COGS per case. We have our sales assumption. We assume that we could sell 2 times more beer at wholesale if we could supply it. So, in other words, no production issues, we could push 2x times more beer through our wholesale channels. If we add the can line, we could increase 15% because that's what we're limited to with our tank farm. And then on the P mix, our product mix, we're going to assume just the same product mix. So if we were to look at our cash flow forecast, we've got here $1 million to begin the year with, and at our sort of normal, no meaningful change to our situation, we would have depleted cash to 657 next year. But we still would have enough room in there to pay $300,000 for a can line. That's off the cuff what we think. However, the real test is to put numbers to the page and see what the numbers bear. So let's see what this looks like with new equipment. So this is our assumptions based on baking in that new canning line. So up top, remember our baseline was to assume we could sell 5% more packaged beer revenue, and that's before adding the canning line. However, what we're doing here in this formula bar, if you can see it, I'm taking our prior year sales, which this January sales number is coming from the historical income statement. I'm multiplying by an additional 5%. That's for our original estimate of organic growth before adding new equipment. And then I'm multiplying again by another 15%. This is to accommodate for the new canning line with the limitation of our tank farm. So we're limited to an additional 15%. I apply that formula all the way across, and now we've got revenue numbers that we believe we could push 1.7 here, whereas our baseline budget was 1.5. So basically increasing our revenue 200 grand. Now, let's look at what this also does. If we're going to push out more volume, we also have to account for the COGS as well. So in our direct materials COGS down here, I need to go in and apply the same methodology. And let's just, again, assume that all the direct materials, bill of materials stays the same year over year. Then my COGS on packaged goods is going to increase as well. And I also need to affect my payroll numbers. So I'm assuming that, remember, I have a net increase in payroll of $30,000. I have to increase my brewery payroll, benefits, payroll taxes. So all of the things that are highlighted are figures that have changed as a result of factoring in this equipment. Now, you'll notice that, let me just go down to the bottom line to show you how. Okay, so we think that by turning on this equipment, we could have net income of negative 339, and that's versus our original budget of negative 420. So that's pretty good. It's like an 80 grand swing. So that's positive. We have not considered the cash flow element because the actual purchase of the equipment is a cash effect, not an income statement effect. So let's go look at that. So this is our standard cash flow forecast prior to assuming the new can line addition. What you'll notice here is that we're assuming a $150,000 down payment. We're going to take, I have an error here. This needs to be 150, not 15. It's going to take 4 months to get the equipment in, and then we've got installation costs as well as $25,000. So now, after considering all of that, our ending cash balance is 167. Oh, you know what? Let me change this back. monkey with that. So now we're at 332, whereas prior to buying this equipment, our ending cash was sitting here at 657. So we're in a much tighter cash position at the end of the year. And then when I run this scenario, I realize, oh, by the way, my equipment's not even going to be live until Q4, so I better go back and rerun the income statement to accommodate for that. So now in this version of the income statement, I have changed the top line, this packaged beer wholesale. You can see that if you can see the formula bar, I'm back to just 5% growth, and that doesn't change until the new can line comes online. I'm assuming in November it comes online. That's when I can push through the additional 15%. Why November? Because if you notice from the cash flow, we were going to have it installed in September. Okay, so how did I get to November? Well, it's going to take you, some time to get the equipment calibrated, and also then you're going to have the beer that is going through the waiting time of processing and going through your fermenters, and then it finally gets canned, and you don't recognize that revenue until about 4 weeks later. So we've actually, in our first year one, we've only got about 2 months of increased sales. Okay, so now that brings our expected revenue down from the 1.7 we were thinking. And and then also on your payroll is probably going to jump up before you can reap the benefits of the new revenue, because you got to get the people hired before the can line goes live. So you've got a few extra months of burdened payroll. And then at the end of the day, when it all comes down, realistically, you're looking at net income for the year 410. If you take that all the way back to your original budget, you're only 10 grand ahead of the game. And you've also depleted your cash. Our original cash flow was 657. Now our cash flow is sitting at 332. So you've got a pinched cash flow situation. You've got increase in your income, but not as great as you were expecting, and it might change the way you think about things. So the point of all this is that what might seem like a no-brainer at the first round can open your eyes to the realities of the situation so that you're better educated on what's the right decision for you. So that was a lot, and I'm at time, but that's what I got. And I'm going to pause. Any questions? Well, I sure appreciate you all being here. Thank you.